Thank you. I want to thank everyone for coming. It is 11 o'clock and let's get started. So today, um, what I want to discuss is something that I do believe, hold on a second, Tom Wheelwright. I don't know if you're familiar with Tom Wheelwright, who he is, but Tom Wheelwright is an accountant. Then I'm going to say an accountant, tax strategist, but he's part of the Robert Kiyosaki group. All right. So in a short um in a short video, he said something. I was like, yo, boom, that sparked a big thing in my head because at one time, and this is the truth, this goes to show how lackadaisical you could get so easily. Hold on a minute. And this could show I said lackadaisical. I'm going to say this could show how comfortable you could get, right? And you start like not using certain metrics. But then when but then another when you hear an investor speak about it, like Tom Wheelwright, it snaps you back and you say, I used to teach that and I pulled away. Now I got to come back. So what I'm going to do is a short video clip. Again, it's a short video clip from Tom Wheelwright. And then I'm going to discuss the two metrics that, and matter of fact, in my coaching program, that particular metric I still teach in my metric, but ask me why I fail to look back at it, right? Okay, so let me share my screen. This is again, it's a short clip. So okay, can everyone see my screen?
Yes.
Okay, great. So let's now, I'm gonna play the clip and listen to what he says.
Well, interest rates haven't been coming down. Okay, so what does demand do? Well, demand can push the cap rate down, okay, or a lack of demand can push the cap rate up. So we're going to see what goes on. People who want tax benefits, how much will they want it? Will they decide, well, I'm just going to invest cash and I'll refinance down the road and take my cash out when interest rates go down, thinking that interest rates will eventually drop to the 5 or 6% range? Here's the important thing. Remember that you want to make sure that you are not borrowing at a higher rate than your cap rate, which is your cash divided by your purchase price. Okay. Well, interest rates haven't been coming.
Okay, hold on one second. I'm gonna play only that part. Let me see if I can catch it right quick.
Cash divided by your purchase price. Okay. Well,
Oops, that's not it. Give me one more minute. Well, let me pick it up from right here.
not borrowing at a higher rate than your cap rate.
There it is. Not borrowing at a higher rate than your cap rate. Think a lot of us forget about that. But that's not what I forgot about. Oh, I didn't forget about that. I forgot about the loan constant. That's what I forgot about. So let's get into that. Now, I also want to say we're scheduled for an hour. However, depending on the participation, how things go, it may not last an hour. I'm not going to keep y'all here an hour if it's not no participation. Okay. So let's discuss this. All right. So I know I'm gonna have to make this let me make it a little larger. Is this good right here? Can y'all see that?
Yes.
Okay, great. So what I want to talk about, he said the interest rate. You don't want your interest rate greater than your cap rate, and that's true. Now, and the reason being, so before I get into telling you the reason, why do you think that you shouldn't do that?
You're going to run out of cash to pay the mortgage. And you're upside down with the loan.
There it is. There it is. You're upside down. You're already going into this property negative. So now let's jump into loan constant. Okay. So loan constant basics. This is, I would definitely encourage each of you to go deeper into this, just to look at it a little closer. But for right now, let's give you the basics. Loan constant, also known as the mortgage constant, is a financial metric that represents the annual debt service, which are the loan payments, as a percentage of the loan amount. It is used to assess the financial burden of a mortgage on a property. So here's the formula. Loan constant equals annual debt service divided by loan amount times 100. Okay, so let's just jump into an example. I'm not going to go through everything else. Let's jump into an example. But the example, hold on, I want to make sure I want this one here. Oh, so here's the example of the calculation. Suppose you have a mortgage with an annual debt service of 30,000 and a loan amount of 400,000. Using the formula, the loan constant. Here's the loan constant equal 30,000 divided by 400,000 times 100. That's 7.5% loan constant. That's the formula. How you come up with it. Now let's jump into cap rate greater than loan constant. All right. So here we go, right here. When the cap rate is greater than the loan constant, typically indicates a favorable investment scenario, and here's why. Consider property with a cap rate of 10 and a loan constant of 7.5. This means that the property is generating a higher return on investment than the annual cost of servicing the mortgage, 7.5. In such a situation, the property is likely to be a lucrative investment as it generates positive cash flow. Income exceeds debt service. So investors often see properties with cap rates are significantly higher than their loan constant, as it provides a cushion for covering operating expenses and unexpected costs while still generating positive cash flow. A lot of I'm going to also jump into here when the loan constant is greater, but I want to right now just discuss this one here. Okay. A lot of us, and I think, and when I say, and I'm not going to say a lot, I'm just going to say investors, especially some of the new investors, I think that's something that they don't take into consideration. Sometimes we want the deal so bad to where we want to just make things happen. So what do you do? And okay, so if we overlook that loan constant and just look at everything else, hey, we're going to make money down the line, right? But in the beginning, you see where it's not covering your debt service. Now, there's a lot that comes into play with this. Okay, let's just, because some will say, wait a minute, Darryl, hold on. That ain't right. Because there are certain projects, I'm aware of certain projects. I'm aware, what, construction loans, can I say? Construction loans, you don't have money coming in. But that construction loan is also created in a way where you shouldn't have payments right immediately on month one, month two. Okay, construction loans. Now, I wish Richard was here to that could verify what I'm saying. But I'm talking about going out here. The property is not a construction property. It's a property. It's let me say it's well occupied. It needs some mild renovations. Okay, nothing heavy. Okay, maybe you put in 1 or 2 new AC units. That's cool. All right, but when you underwriting that investment, you should not go into that investment with a negative and say, well, we'll pay a little more now, but 3-4 years down the line, look, this is where it's going to turn. All right, because you'll see the trend. It's negative, and then it's the negative starts coming into the positive. Okay, and that's probably what 2.5, 3 years down the line. You're like, okay, well, see, man, we're going to be looking good 3 years or 4 years down the line. We're going to be doing very well. But that's a risk. That's a very bad risk. But can somebody tell me why that's a very bad risk?
It's more speculation than based on facts. I mean, you don't know what the market's going to be like, a couple of years down the line. You have no idea what the economy is going to do, what turns we're going to take. There's just too many variables.
There it is. Lawrence hit it right on the head. There's way too many variables that could come into play where that property not only stay negative, it take a deeper dive. Then what? Now you're forced into a situation to where you're going to have to sell the property or bank on a foreclose on it. Everyone wants that property. I remember my first one, right? Everybody wants that first property. But you can't skip corners. And Tom Wheelwright, when he said that, it was like, whoa, something just, boom. That's what it is. That's what it's going to be about today. Okay. So now what I'm going to have to do on some of my older underwriting models, I had that loan constant up there. I was able to see that my loan constant was either greater than or less than my cap rate. And then when I got into my new model, I did not add that particular factor to the new model. So I could see that loan constant. All right. So okay. So let's any questions or comments in reference to that for right now before we jump into the next example?
I got a question about the loan constant.
Sure, go ahead.
Okay, so your first example there, 30,000 divided by 400,000 gives you a 7.5% loan constant. That's lower than the 10% cap rate, so that's, I guess, considered favorable. Now, let's just say time progressed. My property is still generating a 10 cap, but now I've paid the loan down to 300,000. Now that gives me a 10 loan constant. Now my cap rate and loan constant are equal. Uh-oh, sounds like I better be watching out. I don't even know why I should be concerned, but let's continue. Now I paid down my loan down to 200,000. So now my loan constant is 15 and my cap rate is still 10. So now I've got a higher loan constant than my cap rate, which I got a feeling your examples, as we get to them, are going to indicate that's not a good thing. But it seems like paying down a mortgage is somehow penalized by the loan constant instead of rewarded. So can you sort that out for me, why the loan constant getting higher, which is a favorable indication of remaining balance, somehow is a bad thing?
So why is my question to you is going to be this. I want to know, why is your loan constant, your loan constant is going up for what reason?
Because I'm paying down the mortgage. The loan constant is my annual debt service divided by the remaining balance.
Then that loan constant should not. So if you're paying down the debt,
Yeah,
you're building equity. If you're paying down the debt, your loan, first of all, your loan constant isn't going to change.
sure it is.
That's number one. No, it's not.
Divide 30,000 by 300,000.
Divide that mortgage loan amount that's in them documents by that payment.
Well, if I started at 400,000 in your example, that's a 7.5 constant. If I pay down X amount of time goes by and I'm down to 300,000 remaining balance, 30,000 divided into 300,000 is a 10. So now I'm at a 10 loan constant.
Yeah, but your mortgage loan doesn't go down.
Right, but that's not a factor of
That is a factor.
no, I mean that's my remaining balance is what I'm saying.
No, I'm saying your mortgage payment don't go down.
True.
If I got a 5-year mortgage loan, right?
Right.
If my mortgage payment, here we go. If my mortgage payment is 5,000 every single month, that don't go down. My mortgage payment stays the same.
I
My
agree.
loan constant stays the same.
No, it doesn't. Not if my mortgage payment divided by my remaining balance. But the balance is going down, not my payment.
The loan constant isn't factored. Let me pull up that example.
We'll pull up the example. Let's look at what 400,000 indicates.
Okay, so here we go right here. Let's go back to the formula right here. So the debt service is 30,000 and the loan amount 400,000.
Right.
Okay. So if your loan amount doesn't, although you're making a payment, what's on those documents is what's going to be calculated by. It's not going to be calculated by your loan your loan payment. I mean, it's not going to be calculated by it reducing. Your loan payment is your loan payment.
Right. My payment's staying the same, but my 400,000 is turning to 300 as time goes by. If that loan amount comment indicates remaining balance.
Bob, so that's not necessarily how the loan constant is used. It's typically used in the underwriting phase to know if this is a good investment for you at the start of it. When your mortgage goes down, it doesn't affect the constant because
Sure it
it's
does.
based upon your the original loan terms.
Okay, well then there's no point in monitoring the loan constant if it'll never change. What I'm hearing is that we want to monitor it as it fluctuates as time goes by. And the only way it'll fluctuate is if the 30,000 or the 400,000 changes. And since the payment's not going to change, the only thing changing is the balance, which it's reducing as we pay it.
Yeah, but again, what Alicia said is your loan constant is going into that loan. Your loan constant is not going to change. It's going to stay the same. What you need to worry about is if, as Tom Wheelwright said, You go into this loan, and what he said, you refinance at a higher interest rate, and the interest rate is greater than your cap. Then you're losing money. You're not gaining money. So you go into the loan. You sit down. You go into the loan. Your loan constant. The interest rate is less than the cap.
which is good.
And that's what we focus on.
I can have
So
a
that-
loan constant of 7.5 and it's not taking into account my interest rate of my money, ironically. So that's what's kind of misleading about loan.
Okay,
constant.
so actually, okay, so here we go. I see where you're going. So I'm glad you said that
So
right here.
So quick question.
Here we go. Now I got to
Darryl.
go all the way to the beginning. I'm gonna have to go all the way to the beginning because he just said something.
Daryl,
He just
but
yeah.
right before you get into that, so are you saying you're going to look at that loan constant in the middle of the loan in order to determine if you're going to refinance or not? Because that will cost you money if you're upside down with the loan constant.
That's what I
So-
heard conventional thinking say, yes.
So well, this is what Bob said, and this is what I exactly heard from Bob. Bob said his interest rate is not taken into account for the loan constant. That's what I heard Bob say. Did I not hear you say that?
The interest rate he's getting on his money.
He
from
said
the
he
bank?
agreed. He said he agreed. Here we go. I'm glad. Okay, so thank you very much for that. And now let's square this away and put this to bed. Okay, we're going to do a rockabye baby on this one here. There it is. Definition: the loan constant is the ratio of the annual debt service principal plus interest to the total loan amount. It represents the required annual payment per dollar borrowed. So the loan constant equals annual debt service divided by loan amount. So what Bob said, he said, and this is when I caught it. He said, it doesn't take into account of my interest rate. Wrong. The loan constant does take into account of the interest rate.
Well, if you're talking about this, Bob, if I refi, I could still have the same $30,000 payment, increase or decrease my interest rate based on my term and still have the same parameters and same loan constant, have changed nothing. Or I can pretend I improved my situation and increase the loan balance and then therefore decrease my loan constant and fool myself into thinking I did something great.
But suppose you refinance that property at a higher interest rate.
I understand. I could finance it higher or lower, but if my only barometer is the loan constant, I could fool myself.
Well, that's not the only barometer that we use. I mean, we
Well, I'm
use
not-
several barometers, but what I'm saying is, suppose that loan constant is greater than the cap rate.
At the outset, you might want to gut check it, but if it starts low,
I'm talking about on your refi.
on a refi, that's a boo-boo.
Well, that's what we just said.
Oh, well, what I'm getting at is if my loan that we were paying down modified my loan constant to go above my cap rate, that somehow is a bad thing when in fact, it's almost a indicator of successful principal paydown. Anyway, I'm hoping to see how that gets rectified in the further examples. Sorry to derail us so much with that little comment.
No, those are good questions. Somebody
Good
else is
questions.
going to have them.
Yeah, good questions. Excellent. But anyway, so as you're looking at your loan constant versus that cap rate, okay, because remember the loan, and I didn't want to get too deep into, I didn't want to go too deep into all this, but I see that maybe I should have taken it from the beginning by going maybe a little deeper into all this. But so The loan constant does take into account of the principal and the interest rate. They're added together. And once you divide that by the loan amount, you're going to get your loan constant. You don't want that loan constant to be greater than your cap rate. You're going to lose money. Okay. This takes us to planning. What do I mean by planning? You do a 3-year plan, 5-year plan. And okay, so it's time for you to either refi the property or it's time for you to sell the property. One or the other. But you look when you get ready to refi, the economy has shifted and it's not favorable. The interest rate that you came in on, which was a 5, has now increased to a 7. So it wouldn't be favorable to do a refi, but you have to make a decision on either you're going to refi that property or you're going to sell the property. And in that case, you're going to wind up selling the property because it's not making sense for you to hold on to that property. Now, you also have to take into account that the next buyer that's going to buy that property is buying at a higher interest rate. So, do you have enough funds in that equity to where the investors could get their money back? Okay, that's something that, and in your underwrite, you should already have factored in not a cap rate that is equal to what you bought that property at, but you should have exited. You should have already input a 2-point higher, right? I go 2 points, 2-point higher than what that market is on my exit. So you got your exit cap. Some people underwrite for the same thing going in, but investors that's been in this for a long time, they're going to increase that exit cap by 1 or 2 points because you don't know what the future holds and you have to cover yourself. Okay. So now let's take a look at the loan constant in the reverse. Let me see, which one was this? This one here was loan constant, blah, blah, blah. Oh yeah, cap rate greater than loan constant. We already know that that's a good one. And this was the other scenario, loan constant greater than the cap rate. Well, we already know from that scenario that this is not where we want to be. So conversely, when the loan constant is greater than the cap rate, it suggests a less favorable investment scenario. Here's why. Suppose you have a property with a cap rate of 8, loan constant 9. In this case, property annual debt service, which is the 9%, it exceeds the return on investment of 8% that it generates. So the situation implies a negative cash flow, as the property is not generating enough cash to cover the cost of servicing the mortgage. Investors should be cautious when the loan constant exceeds the cap rate, as this can lead to financial strain and negative cash flow. It may require additional capital infusion to cover the mortgage payments and operating expense. In summary, cap rate and loan constant are essential metrics in real estate investment analysis. Cap rate greater than the loan constant indicates potentially lucrative investment with a positive cash flow, while a loan constant greater than the cap rate suggests a less favorable investment with a potential negative cash flow. Investors should carefully assess these metrics to make informed decisions and ensure the financial health of their real estate investment. Okay, so this plays a very this right along with your other metrics plays a very important part in your investment strategy, and that's what it's all about. Your investment strategy. What is your strategy? What is your plan? If you're underwriting and you see it, which you could definitely see without even looking at, and matter of fact, I'm going to say that too. You could look at your underwriting and tell without even looking at an IRR, without even looking at help me out here, equity multiple. You could look at your underwriting and tell it if that's a good deal or not. So question, what can you look at on that underwrite without even looking at the IRR, without even looking at the equity multiple? What can you look at to see if that deal is a good deal or not?
You can look at the DSCR, you can look at the NOI.
Okay, so there's no DSCR. Maple Leaf, there's no DSCR. Don't be scared. Come on, everybody. You're nervous? I'm gonna call you. I'm gonna call your name. I'm gonna call your name if you don't tell me something. All right, here we go. I'm gonna call out a name. Carmeletta. What can you look at on that underwrite? And don't see everyone. I don't want you to be nervous coming here. And the reason why is because this is an educational platform. You can't make a mistake. We're here to help you because you're going to be going out here getting properties. You're going to be underwriting properties, and you got to make sure you got to make the right decisions. So by being silent, it's not helpful. It's not. To ask questions, to inquire, is to help you grow. Right? So let's ask this question one more time. You don't have an IRR. There's no such thing. There's no such thing as an IRR. There's no such thing as an equity multiple. There's no such thing as a DSCR. But you have these numbers right in front of you. What can you look at that's right in front of you to say whether if you want to move forward with this deal? You don't know nothing about a loan constant. You don't know nothing about a cap rate. What can you look at?
Cash flow.
NOI.
There you go. That's it. Look at that cash flow. Now, someone said in the why, I'm jumping to the cash flow. Why did I jump to the cash flow and not say yes to the NOI? Can someone tell me?
You want to take debt service into account.
Exactly. You want to take the debt service into account. The debt service doesn't come before the NOI. The debt service comes after the NOI. So what's after the NOI is going to be the cash flow. That's the money. So that's the money that goes into your pocket, the cash flow, right? That goes into your pocket. That's if you don't have no other investors. Now, if you have investors, you got to share, right? You got to divvy it out. So now I want to say this. And this is something that you're going to have to decide individually or with your team. How much of a cash flow is acceptable for you to move forward with the deal. Okay. Now, again, that's now, so remember, that's an individual thing. That's something that you have to decide on. Or if you have a team, you and your team have to decide on, because I don't know what your plan is. Like Rob said, I don't know what your strategy is for going into the deal. Right? And each deal is different. My deal is going to be different than your deal. Okay? You may have investors, I may not. If I don't have investors, I may be willing to take a little less of a cash flow. If I have investors, I may want more of a cash flow because I know I have to divvy the money out. Right? So that's something that you can think about on your own, what kind of strategy you may be going into when it's coming into these investments. So, do we have any questions in reference to what was covered today? No questions?
Yeah,
Anybody working on anything?
I think this was a really good teaching. Not everybody looks into that, and it's good to one get a refresher, but also show new investors that there's more to just looking on the surface level, or what they say, the napkin type of figures.
Yeah, sometimes back of the napkin doesn't work, and Alicia's correct, right? And in today's economy, things are changing so fast. I mean, um, you have to. I'm a strong believer in doing complete underwrite. I don't believe in napkin deals. I don't. I believe that you should sit down, take the time to underwrite the deal. Now, if you've been doing this for like 10, no, I won't even say 10, but if you've been doing this for a good amount of time, right? 5 years, you're in one market, but that's a major factor. No more than two. You no more than two. You're in no more than two markets. Your two markets like the back of your hand. You're so entangled that no one could tell you nothing about that market. Then if you happen to say, okay, well, Darryl, I don't really sit down and do a complete underwrite. I already know about the markets. I already know about all the different areas. I know if I'm making money or not. And if you've been doing this for that long, I'm not going to tell you to sit down and do a complete underwrite. But if you are learning that market, you need to sit down until you know that market better than the person that lives there. You need to really sit down and underwrite that deal. Because if you don't know that market as well as you think you do, you can make a big mistake. A big mistake. If you don't know not to cross the street, because that's a totally different area, you can make a big mistake. Okay. So today, just to sum up what we discussed today, it was a conversation it was a short video that Tom Wheelwright had mentioned, that to be careful about purchasing the property where the interest rate is greater than the cap rate. Okay. And that led us into discussing the loan constant, right? Not having your loan constant greater than your market cap rate. That's what that's what it led us into. And we gave an example of a loan constant that was greater than the cap rate and a cap rate that was greater than the loan constant to show you that what type of a deal was good, what type of deal wasn't. And then that led into the final conclusion of if we didn't even have a loan constant, if we didn't even have an IRR, if we didn't even have an equity multiple, if we didn't have none of those other metrics, what else could we use to see if a deal was a good deal? Could we move forward with the deal? And with that, it's going to be individually based or based on you or your team, what your plan is, your strategy, how you plan on attacking this particular property, and so forth. Okay. So, any questions in reference to what we discussed? No. All righty then. All righty. So I am working on a deal. I'm not going to keep y'all. I'm gonna let y'all go. But currently I am working on a particular deal. I was hoping that another investor was coming to the show today to discuss it. But I'll be getting with him.
Let's discuss it.
Doing yeah, I'll be getting with him during the week, and then once I get all the data and the information, you know what I do, everyone. I bring it here so we could so we can underwrite it, look at it, and say, hey, do we want to move forward with the deal? That's how we work here, right? So I want to, if we don't have any other questions, like I said, I'm not going to keep you here till 12 o'clock. But if you have something that you would like to discuss, we could discuss it and turn it into something educational so that others can learn. Anything?
I have
No?
a question. Have you ever invested in Hawaii?
No, I've never invested in Hawaii. No. You?
Oh no, I'm just learning.
Oh,
My
okay.
children
Okay.
are out there in Hawaii, so trying to figure out a way to afford to be out there with them because they have four
Okay.
of my grandkids out there with them.
Ah, I see. I see. I see.
Are they on a
All right.
particular island?
They're on Oahu.
Oh, wow. Okay.
They had a 10-year military commitment there. So right now, I think we're down 2 years. They have 8 more years. Grandkids be teenagers. The oldest one to be grown. I got to
All
figure
right.
something out so I can get there too to enjoy them while they're young, watch them grow.
Right. So if you invest out there, you plan on staying out there?
I don't like it that much.
So let me
There's
just
no
say
place
this.
like the mainland. How about that?
There you go.
It's a good
Um,
place to visit or invest
yeah,
in if it can create some cash flow for you.
right,
But long-term living, it's kind of
right,
rough out there. They have 3 to 4 generations living in one house because it's just not affordable out there for the native
right,
people. It's just really heartbreaking what they're doing to the people on the island. But
right. So what I would say to you, if you're looking at getting into investing in commercial multifamily, the main thing I always say to everyone is pick your market, but no more than 2 markets. Know everything about that market. You want to know the laws about that market when it comes to evicting. You want to know, of course, numbers, okay? And then within that particular market, you want to go into the sub-market. You want to know what sub-market to go into, what sub-market not to go into. Okay. Then if you live in that particular market that you're looking at investing in, make sure you drive the market, right? Know the market, drive that market day and night, weekday, weekend, everything. Go to those meetings, city planning meetings, all of that. See what's going on. Okay. If you don't read the newspaper, start reading the newspaper. Because you're going to learn a lot about what's in those markets. You're going to also learn which one not to go into. Now, unless you're a big, heavy risk taker. Right? No more than two. Why? Because you also have to build a relationship with the people in that market. The brokers, the property managers, the lenders. There's no way you can have a strong relationship with 50,000 brokers. Ain't no way. I don't even want to hear it. You meet you a good broker in that market, you take them to lunch, treat them to breakfast, become very good friends with them. Follow them on Facebook and LinkedIn. If you see that they're having a party and it's their birthday, call them or send them a message. And then you write that down in your calendar that it's his birthday on July 15th. So next year, you're ahead of the game. Hey, man, happy birthday. Or her, happy birthday. Right? Go to their office. Talk with them. But while you're sitting in that chair, let your eyeballs do the looking. What do I mean by let your eyeballs do the looking? Look for pictures, things that they may be interested in. And then when birthday come around or the holidays come around, I don't know, some of you may do Christmas, Thanksgiving, all of that. And if you do, you may want to send a little gift. Hey, here's a gift. Merry Christmas. Happy New Year. Happy Thanksgiving. And don't forget about your lender. Once you build that rapport with that lender, you hold on tight to that lender. I know some people say shop around lenders. Well, shop around a Fannie. You don't need to shop around. I would say hold tight on shopping around a Fannie Freddie lender because they all deal with Fannie Freddie. Now, yes, some may be giving a little different rates and discounts and stuff like that, but build that rapport with that lender where whatever kind of discounts that they do give out, you could get. Now, I will say also make a relationship with your local banks. Local banks are not the same as Fannie Freddie. They have different loan products. Their rates may be a little higher, maybe a little lower, but depending on what you plan on doing, that Fannie Freddie may not want to give you a loan, but that local bank will. So you make sure you get in good, talk with your local banks. See what they offer, what kind of products. You'll find out that majority of the banks do not do 30-year loans. Amortized over 30 years. Okay. You're going to find out there's a difference. Okay. So I see there's 6 comments. Let me see the comments. Anything? Okay, so we're good there. All right. If there are no further questions, well, first, are there any other questions?
I got one for you, Darryl.
Sure, Robert. Rob?
Do you? Yeah. Well, this is Bob, but I had to leave. And when I got on my cell phone, now that comes up Rob.
Oh, so this is okay. Go ahead, Rob.
Hey, you're gonna evaluate that project that you said you're working on. Just for the heck of it, do you assume, just for quick numbers sake, maybe we'll call it armchair math, napkin math, whatever. Do you assume 50% expenses after you've got the gross rent, just to see if the asking price is anywhere in your ballpark?
Well, you mean if we're doing a back of the napkin type deal?
Yeah, well, if you're just doing some quick math just to get a feel for whether or not the project is even worth pursuing based on the asking price of the seller.
If you're going to do, well, if you're going to do one of them back of the napkin type things, then that's nothing but a standard market number, 50%. You could use it.
Right.
Yeah, you could use it. Yeah.
So with that being said, a 6 cap is equivalent to like we'll call it the residential's 1% rule.
Well, that's something that I don't use. I don't use a 1% rule in commercial. Commercial, in residential and commercial is two different things. If I'm going after commercial, I'm going to sit down and just underwrite the property. I want to, and also again, if you have a lot of experience, I'm glad Rob brought that up, right? So, and I'm gonna go back to what I said. If you have a lot of experience underwriting, and you know that market like you know the back of your hand, okay, then if you sit down and say, well, he's asking this, the market cap is this, blah, blah, blah. And you do the back of the napkin type thing. If you think it's a good investment, that's up to you, right? Again, I don't do back of the napkins, and in my coaching program, they're not going to do back of the napkins either. They're going to underwrite each and every single deal, right? That's how it works with me. Because I just don't use a standard number, right? Your back of the napkins, you're going to use a standard number. You go, okay, 50% expenses. All right. But on an older property, you may have to bump that up, okay, on an older property. And one day when we have more time, maybe I'll get into that to discuss the different expense ratios by the product itself. So you wouldn't use the same expense ratio on a C property on a A property or a B property. Okay, that's what I mean, and I'm gonna stop right there. So, and we also get deeper into the market when I say market, I really mean. I guess I should just use the word I really mean, which is submarket. Or nope, I'm gonna go even deeper. I'm gonna go even deeper. I'm gonna go neighborhood. I want to know what is the market cap rate in the neighborhood within a particular radius. All right. Because once you go up, like, all neighborhoods aren't the same. If you're from, I'm going to use this just as an example. If you're from Philadelphia, then once you cross that street, don't even think about using those numbers over there. That's just how Like you can mess up your underwrite. By you not knowing, don't cross that street. Or there's an L. Now, I don't know if you all know what an L is. For those from Brooklyn, from New York, we know what L's are. Okay, those are the trains that run above ground. That's the L. We call that the L. All right. So, and in a lot of neighborhoods, you don't cross the L to pull numbers, because that other side of that L, which may be, I'm just gonna say, maybe if anyone's from New York, you may know what I'm talking about. Bed-Stuy versus Brownsville or East New York, right? Brownsville, East New York borders each other. Brownsville, Bed-Stuy borders each other. Okay. So you will know, don't pull numbers from Bed-Stuy if you're looking at a property in Brownsville, and don't pull numbers from Brownsville if you're looking at a property in East New York. Those names I'm calling out are neighborhoods. Those are districts. Right? So I just wanted to say that, and now it's 11:57. Oh wow, I was able to talk. But are there any questions in reference to whatever we covered today? No? All right. I hope that you was able to get something out of today from the Commercial Underwriting Show. And we meet every single Tuesday at 11 o'clock Eastern Standard Time. Please come back. If you have, when you come back, bring questions. Bring questions. Let us answer your questions. Bring underwrite. If you don't want to bring the whole underwrite, but you have questions about certain things on the underwrite, well, bring the question. Bring that particular piece so that we can help you with your underwrite, right? If you're looking for someone that can help you with your deal, bring it. Talk to us about it. Maybe we could help you with your deal. If it's a deal that's, that is going to meet the criteria of how we can help you with it. Okay. So I want to say thank you all for coming out to the Commercial Underwriting Show. And I look forward to seeing you all back here next Tuesday at 11 o'clock Eastern Standard Time. Thank you very much for coming.